Thank you for watching the Housing Oregon YouTube channel. Be sure to join our network and get involved in the work that we are doing. If you can, please like and subscribe. It helps us build this channel, which serves as a platform to communicate with our members. This video is part of our 2025 annual conference. We're looking for folks to be on the conference planning committee. Please email info@housingoregon.org.
Good afternoon, everybody. I am sorry that I was scheduled right after lunch. I too would rather be taking a nap, but the problem is you give me a microphone and put me in a round room and I will talk to myself. So here we go. So here's what you signed up for or were told to come to is Flex Lending Program from Oregon Housing and Community Services, tailoring mortgage lending to borrowers' needs. I'm Scott Shaw, Assistant Director of Homeownership Lending. That's a really fancy way of saying when it comes to lending for homeownership, my team, we're your folks. So 40% of my team is here. We are a mighty group of 6, and 2 of them are here. Will I really? Oh, see? What's funny is they gave me the slides. I help with the slides, and I still speak ahead of the slides, folks. So next slide. There we go. So we're going to talk about, you better give me that so that I can kind of walk and talk. Because it's going to just make my life way, way easier. Okay. You guys, here. I'm going to let them introduce themselves.
I'm Susan Roman. I am the Field Business Development Representative. Is that what I am? Yeah. For homeownership lending and the Flex Lending Program. I work in Salem.
Hi, I'm Christine. Am I getting that in there? Hi, I'm Christina Kluver. I'm the Senior Lending Program Analyst for the Flex Lending Program. We work out of Salem at Oregon Housing and Community Services.
So I'm not going to tell you how much time we each have been in the business, but the 3 people here represent about 95 years of mortgage experience. So we are seasoned, I guess is what we'll call it. So I have been working with Oregon Housing since December of 2018. So what is that, 6.5 years? I started out in the multifamily side of the world, working on LIHTC tax credit deals. And then I transitioned over to home ownership, where I started building the Flex Lending Program. And we're probably going to talk about when that all happened, isn't it? Yeah. So, oh, look at that. All right. So here's the history of OHCS, right? We started lending home loans in 1977. And basically what we did is we sold bonds, we sat on a pile of cash, and when our approved lenders came to us with a loan that met our requirements, we bought each individual loan. By the way, there are handouts at the table. You can take them home with you, throw them in the garbage can, give them to your kids, turn into planes, whatever you want to do. Just make sure that they get reutilized in some way, shape, or fashion. So I came to OHCS, like I said, in 2018. By March of 2020, they found out what I used to do. I was in hiding. It was almost like I was in a witness protection program. I used to do capital markets in the private sector. So all of that being said, they came to me and said, we want you to launch a TBA program. And I said, you don't want to do that. It's only worth 6 basis points. Their eyes crossed, and they said, please come do this. So I told them I didn't want to do it anymore. I would have set up the program, and in 6 months, I would be done, and then I wanted to go back to multifamily. In 2023, we launched, so 3.5 years later, so I was a little bit off on my time estimate of 6 months because, well, it's not the private sector. So we launched in March of 2023, and we basically immediately began working on revamping our whole loan bond program because it just wasn't really efficient. See, every state gets a certain amount of tax-exempt bonds that they can issue. And once you're done, you can't issue anymore. So you got to figure the most efficient way of doing that. If you're buying whole loan bonds, you lose somewhere between 7 and 10% for what they call loan loss reserves. But if you get really tricky, what you do is you wrap those puppy into a mortgage-backed security, and you no longer have loan loss reserves because your payment flow is guaranteed to your investors. So that is why, after we launched in March of 23 with what we call a TBA program, and that is mortgage-backed securities that we issue out into the private sector that don't have any bond implications. Rate's a little bit different. The loan product structure is a little bit different. We'll talk about that in a bit. So anyways, we started working on the first-time homebuyer program to replace the what you guys would call the Oregon bond. We launched that in November of 2024. Let's see here. What do we want to talk about this? Well, yeah, but let's also talk about the fact that, so we sunset, here's what we did. We had, was it 9 or 8 approved lenders with the legacy bond? 9? But we had like 6 or 7 that were actually using the program. We hadn't added a lender in like 5 years. When we launched Flex Lending, we had 34 lenders. And I think we have climbed up to a peak of like 36 or so. I think we're back down a little bit due to mergers and acquisitions and things like that. But anyways, what we wanted to do was make sure that more lenders had access so that they could offer the product to more lower income Oregonians. So what we did is we offered the lenders this new program. We call it First Home. And basically, like I said, it is a first-time homebuyer program that is IRS-based, which essentially means, like I said, it is the bond replacement. We allowed those lenders to transition over. One of the options that we got the ability to do, and again, it's probably farther into the slide, so I apologize for my team here, because like I said, they set it up in a really nice fashion, but I get excited about talking about this, is we didn't have the ability with our legacy bond program to be able to put down payment assistance with it. We had this thing called closing cost assistance, but the borrower still had to bring in their down payment, which kind of a problem. So we transitioned everybody over. They were kind of excited about it. So from November to March, we basically lost all of our lenders, closed up that pipeline, and we sunsetted the legacy bond program in March of 2025. What's the next slide say? Okay, nice. All right, I can talk about this. Is that my slide? All right. So here's our goal. I mean, this is what we had in mind the whole time, right? Is to provide stable pathways to homeownership and help people that are low to moderate income realize that dream of homeownership. Pretty simple, right? We wanted to support communities of color, and we're going to show you kind of some of the creative ways that we came to be able to do that, including marginalized and rural communities, and we already know it, homeownership creates stronger communities. Thank you for shutting the door. That was awesome. Is that my next slide? Right on. All right. Wow. I haven't looked at this in a while, guys. So here's our spectrum, right? This is the individuals and the families that we're looking at serving. And it's anywhere between the double income, right, all the way down to people that are on Social Security income. And in fact, I'm kind of a spreadsheet nerd, and we actually have the AMI of every family that we've ever done loans on, and it is amazing to see what that product mix looks like. Next slide. So the idea was to, in fact, we surveyed our community partners first and foremost and wanted to know what they need. And it wasn't just the lenders, it was the nonprofits, it was the community organizations, and we built this structure surrounding the input that we received. The idea is affordable DPA offerings, and it's actually probably one of the more complex DPA offerings of anywhere in the country. Hold on. Yeah. Homebuyer education is a huge part of it for those people that are our homeownership centers in the state of Oregon. I tell you what, we're a little bit unusual. Everybody that is a first-time homebuyer in our program has to do homebuyer ed. We don't do just one, and we do have we have a couple of online options, but we honestly strive for people to meet with the homeownership centers and to get their homebuyer education through the homeownership centers. We think it's super important. Here's the deal. They're going through and they're accomplishing what's arguably the American dream. And it's scary, especially if you're like a first-generation homebuyer. And the reality is that you need resources, you need relationships, and that is why we drive people towards these homeownership centers, right? Is we want borrowers to build a relationship with somebody that, heaven forbid, something happens after they buy that house, that they have the resources to go back to be able to help them so they don't lose their home. Sweet. All right. Okay, so here's where we go. So we started out with flex lending. It was just this, what we call a TBA product. That was that one that goes to the private sector. When we revamped our first-time homebuyer product, what we did was we kind of renamed things a little bit because we wanted everything under that flex lending umbrella, because we really like the name because it actually kind of says what we're doing, right? Is that we've got nice flexible lending products so that whatever your guys' financial situation, we're going to be there to help. So our newest product is First Home. It is basically a first of its kind first-time homebuyer product. It's IRS qualifying. We'll probably, do we have a slide in there to explain kind of what that IRS qualifying is and all of that about the, okay, so we'll talk about it. So when I say an IRS qualifying first-time homebuyer product, what I mean is that we look at, it has a structure just like the legacy bond program had. And what it is you have to be a first-time homebuyer, or you have to be a veteran that has never used a veteran exemption before that was a previous homeowner, or you have to be buying in a targeted area and then you can be a previous homeowner. So, oh my goodness, a targeted area. Yeah. And what's funny is that every state's got targeted and non-targeted areas. These are all set up in conjunction with the IRS, believe it or not. So a targeted area is an area that has, according to the U.S. Census, and they adjust them every census, is it needs additional economic development. It is a lower income census tract. And so there are some places where we've got whole counties that are called targeted areas. And then we've got some counties where there might be one MSA, or census tract, sorry, and there might be some where there's none. So when you get that targeted area, not only can you be a previous home buyer, you get higher maximum purchase price limits, you get higher income limits, and in fact, I should, well, yeah, it is a great rate. So today, I was just talking in one of the sessions that I was in because I was loving to give some input. If you were doing an FHA loan with no DPA, it was 5 3/8 this morning, and with a 4 to 5% DPA, and we'll explain that here in a few minutes, the rate was 5.875. So, yeah, it's really awesome. So, but the catch is, back to where we're talking about the way that these products are set up. You're a first-time home buyer, you're buying in a targeted area, or you're out. You got to be within purchase price limits, you got to be within income limits. Income limits means the whole household, everybody that's over 18, not who's on the application. And where we're going to go with the next step product, which was the first product that we rolled out, it was way easier to roll out because we have a statewide income limit. It's $125,000. Doesn't matter whether you're a first-time home buyer or a previous homeowner. The only catch for any of our programs is that we do purchase only. It's a single family. And what was the other thing I was going to say? Oh, yeah, you can't keep your house. That's what I was getting at, right? It can be the only real estate that you own because we're not empire building. I mean that respectfully.
And with next step, you get always have down payment assistance, DPA.
That is true. So what you're saying is with Next Step, you always get DPA. And the reason is the first home program, or product, we have a lot of CLTs in Oregon, and we have a lot of CLTs coming online, and community land trusts have a different way of calculating the loan to value, and typically they don't need DPA. So, and typically they are first-time home buyers. So what we do is we offer a no DPA option, which is why that super low rate that I was talking about. Next slide. So, oh, yeah, sorry, industry lingo, thank you. DPA stands for down payment assistance. It is a second mortgage loan. In fact, nope, we're gonna talk about eligible properties, but we'll get into how our DPA is structured here in a few minutes. Eligible properties, CLTs, community land trust, same thing. Newer existing one unit, single family, PUDs, condos, townhomes, manufactured homes that are single or multi-wide. Not doing co-ops at this time. We are looking at a manufactured home co-op option. We're pretty sure everything's all good with it, but next week we go to Fannie Mae in DC for their what they call an HFA summit, And we need to have a few more conversations with them just to make sure that everything, we want the lender safe, we want the borrower safe, we want, obviously, the agency safe too. Let's see here. We're not doing multi-unit at this time, but boy, oh boy, in the future, no investment property, second home, no raw land. Makes sense, right? Does anybody have any questions? Sweet, next slide. Oh, I love it. All right, so I already went over this, but it's kind of fun, right? I almost don't need slides. But the reality is that we're back to the same thing. We really do love our providers. So next slide. Okay. All right, so let's talk about this. Why is it called flex lending? Well, we already talked about that, so we're going to skip that. Mortgage-backed securities. Do you guys want to know anything about mortgage-backed securities, TBA, and all of that fun stuff? Okay, I know you do. Okay, so mortgage-backed securities are basically what we do. So I told you guys about whole loans, right? Where we would buy it, we would sell a bunch of bonds, sit on a bunch of cash, and then we pick up a loan, right? We would buy that individual loan and we put it in our portfolio. Then what we did is we got fancy. We put them in a mortgage-backed security. Well, what that really means is that we're taking loans within a half-point interest rate range, from like, let's call it 5.25 to 5.75, or 5.75 to 6.25, that are all the same type, whether they're Fannie Mae, or whether they're Freddie Mac, or whether they're what we call Ginnie Mae, which is FHA, VA, USDA Section 184. So what we do is that we actually, instead of picking up each individual loan and plopping them in our portfolio, is we actually exchange those notes for a security. That security is insured by either Fannie Mae, Freddie Mac, or guess it, Ginnie Mae. And what it does is it guarantees us cash flows, is what it really does. There's loans that, and this is way too far off the rails, but there is what you call actual, and schedule. Actual is what the borrower actually pays, is what the bondholder actually, or what we actually get forwarded to us by our servicer. And then there is schedule, what the borrower is scheduled to pay. Even if the borrower pays zero, the servicer forwards that amount. So back to where I was talking about it, we can extend the amount of volume that we can do by simply going from a whole loan product to a mortgage-backed security-based model. What happens is when we exchange that wrapper for individual loans for mortgage-backed securities, because we're guaranteed that payment stream, our bondholders are happy and require less loan loss reserves, which in turn allows us more volume to go out and lend to Oregonians and help them realize that dream of home ownership. Whew, that's a lot of words. Somebody have questions about that? Okay, go. Okay, say that one more time for me. Yes, so the question is there a credit score requirement for the programs? So when Oregon Housing created its lending programs, and especially when we rolled to this mortgage-backed security method of doing things, we enlisted some service providers. One of those was Idaho Housing. They are what's called our master servicer. So every loan that goes through our system, so actually let's kind of back that truck up just for a smidgen. And here's how we operate. We set the parameters, we set the guidelines. We don't actually lend the money. We have approved lenders. Those approved lenders, the borrowers go to those approved lenders, they make an application. That lender makes a determination whether they're gonna approve that loan or not. The borrower goes to closing. That lender funds that loan using their own money, and then they present that closed loan to be purchased. Idaho actually facilitates that for us. And part of that transaction, they assume the servicing of that loan, which means they're the person that the borrower writes their check out to every single month. And part of the reason that we chose Idaho Housing is Idaho Housing doesn't ever sell the loans. And we actually have a great rapport with them, and we actually monitor that portfolio. We know what's going on with the loans that are going inside that portfolio, which is super important. Now back to our partners, we can involve our partners and say, hey, we got some problems here, right? How can we work to overcome that? You have a question back here. Idaho Housing is a housing finance agency. Every state has an HFA, or housing finance agency. Oregon's is OHCS, Oregon Housing Community Services, that's us. Washington's is Washington State Housing Finance Commission, and Idaho's is Idaho Housing and Finance Association. We are not selling our loans. Oh, wow. And you asked about credit scores. I swear we're getting back to that, right? But let's go. So most people don't already know this, is there's two parts of a loan. There's the loan part of the loan, and then there's the servicing of the loan. The servicing is the person you pay. They actually get paid part of the interest rate on your mortgage loan, usually 1/4 to 0.5% of that interest rate, to make sure you pay, make sure that the accounting is done, what's interest, what's principal, make sure your taxes are handled, make sure your insurance is handled, make sure if, heaven forbid, there's a foreclosure or a fire, right, that everything is all handled appropriately. And then they divvy all of those funds off and hand them to the investors. So that's the servicing aspect. So the real key important for us when we chose a partner for a servicer was somebody that wasn't going to be selling things and moving things. Once that servicing hits to Idaho Housing, which is called, their servicing arm is called Home Loan Serve, it doesn't go anywhere unless if we authorize it, and we're probably not ever going to authorize it, right? So when it comes to the loan part of the loan, that's the mortgage-backed security fund stuff that I was talking about. So literally, once the loan hits Idaho, we bifurcate or split things. So the loan part of the loan gets put into an MBS, or mortgage-backed security, and the servicing stays with Idaho. Now, back to credit scores. So credit scores, we don't have any overlays for credit scores. Overlay is basically something that we have in addition to something else. The reason that I went to Idaho was Idaho has no overlays. We get to choose what our limitations are. For conventional, we have no overlay, which is a 620 credit score. For government loans, we are at a 620. 620, unless you're manual underwrite, and then you're 640. So, yeah, ask away. Yeah, yeah. That's not the stuff that we're worried about. In fact, we did a technical analysis. This is how spreadsheet nerd I am. I went back through the last 20 years of business before we made the decisions that we made to see how many of our loans were over 45 debt ratio, over 50 debt ratio, over 55 debt ratio, under 620 credit score, just to see what part of our business it was and how much it performed. And then what we did is we reached out to our partners. We reached out to Utah, Washington, Idaho, New Mexico, Colorado, and asked them how those loans performed and where we should set our limits. And so that's how we ended up with 620 on the FHA, unless if you're manual underwrite. And then if you have no credit score, you can do that with alternative means.
Sorry, I don't.
No, you've been an underliner forever.
Underliner. So with the credit score, with somebody who has no credit score, which means they have no credit, and there's many, especially first-time home buyers, low to moderate income borrowers, you're going to find that they're going to have no credit, which that's fine. What we're going to be looking for is that sometimes you're going to have no credit score, but you're going to have a bunch of collections or other things like that. We want to see at least 12 months of clean credit, no collections, and not have a credit score. When we do loans that have no credit score, it's a minimum of a 640 credits, or I'm sorry, it's a manual underwrite. So we underwrite those a little bit differently than we do with the 620 credit score. So, yeah.
Yeah.
Oh, sure.
It's such a good question. We rely, as Scott said, on our approved lender partners, and they will run the file using Fannie Mae or Freddie Mac. They could be running it under a VA loan for somebody who would qualify. Whatever those agencies determine is going to be acceptable, we will follow that 100%.
So, and just to follow up, yes. So that's what the lenders are going to be looking for. We don't necessarily underwrite the file. We typically, we're just giving out the down payment assistance. Yeah. So it's, oh, okay.
Thanks.
So when it comes to the underwriting piece, it's going to be up to each individual lender, but they have agency like Fannie Mae, Freddie Mac, VA, FHA. They follow what they require, and that's where your utility bills come in. If they can see like a landlord history for the last 12 months that's been paid on time, I mean, that's a compensating factor. Say somebody's been paying $2,500 for rent for the last 12 months, and then all of a sudden we're going to have a mortgage payment at $1,800. That is a huge, that's really important because that shows what kind of risk we're taking, which is it's lowering the risk. So the utility bills, the landlord rents, those sort of things, yes, we do look at all of that, and that's how we build the credit for them. And it's not necessarily us. I'm talking from my previous experience of being an underwriter that I know that that's what they look for. So that's what the lender's looking for, and we follow what the lenders do, essentially.
All right, good.
You can talk about TBA.
Yep. So for those of you guys that took a picture of the last slide, delete it because it actually is misleading. It doesn't make actual mortgage sense. So, because it's trying to delineate between TBA and MBS, and my communications people, I love them, but they don't speak mortgage. So, down payment assistance. So we talked about this. Yeah. So our DPA is based on, or down payment assistance is based on the total amount of the first mortgage note. We have 2 types of DPA available. Next slide. Okay. This is what's really, really cool. So this is what's exciting and actually annoyed some of our service providers, to be quite honest with you, because it is, like I said, is arguably one of the more complicated down payment assistance products in the nation. It's pretty simple to me. We have a standard DPA of 4%, and we have a 5% focused demographic DPA, which is going to be on the next slide. But here's what you need to know. If your borrower's area median income, or AMI, is 80% and below, they have a silent second that is no payments, no interest. Standard DPA, at the end of 30 years, it's forgiven. If they do any refinances or if they sell it or what have you, they pay it back if it's before that period of time. Pretty simple. If your borrowers are over 80% AMI, we do not tell you tough luck. We say, hey, we've got an opportunity for you. We're going to go ahead and give you a DPA loan. However, you're going to pay it at 1% over the note rate of the first. And what you do is you pay back into that fund that help other people that are below 80% actually realize that dream of home ownership. So it's kind of fun. They help. So our mandate when we got DPA, our DPA was general funded, was to create a fund that is perpetual. And so this is kind of how we bifurcated it, is we went, okay, if you're at 80 and below, we don't see how you're probably going to be able to come up with down payment assistance. But if you're 80 and above, I actually probably still don't see how you can find save for down payment. But the reality is that there is a different stance on that. So we basically said, if you're above 80, we'll still give it to you. You're just going to help the people that have lower income than you be able to buy a home in the future. So, what's that? Oh, yeah. All right, we'll get to that. Hold on just one second. If you're above 120% area median income, or AMI, which very few of our loans are, but we do that, it is a 10-year loan. So basically, you pay it back faster again, so you can help more people quicker. And one of the things that Susan was saying is you can stack it. Our big deal is that just because we're giving you 4 or 5% down payment assistance does not mean you cannot use other sources. We encourage it. Stack it deep. All right? Let's get the most subsidy we can and leverage it as best we can. Next slide. Okay. Focused demographic DPA. And hold on, I'm going to cheat real quick just to make sure that there's nothing about, do you have on the, you do, okay. I didn't want to get ahead of myself. So here's our focused demographic DPA, and the details of the focused demographic DPA is going to be on the next slide. This is for borrowers that are up to 120% AMI. So again, 80% and below, it's a silent second. But we do this a little bit different. Our focused demographic DPA is designed for people that are in underserved communities, hopefully for communities of color. And we'll talk about how we develop that here in a few minutes. But it's a 5% DPA, so it's more DPA and more favorable terms. So it is a 15-year term for borrowers that are 80% AMI and below, and then that loan just goes away, it vaporizes. Again, what we call a silent second, no payment, no interest, right? And then if you're over 80% AMI, all the way up to 120% AMI, what we do is we turn it into a 30-year loan. We don't do that as a penalty. The idea is that we stretch it over that longer period of time so there's a little bit lower payment so the borrower can borrow more or qualify for more home. Next slide. Okay, so we stole this affectionately from our folks in Minnesota. Minnesota ran into a little bit of issue with the Supreme Court and they lost. And so they had a preference policy is what they had. And their preference policy was not seen as compliant. So here's what they did is they went through their 45,000 or so loans and they said, okay, what attributes of a mortgage loan is most likely to hit communities of color? And here's what they came up with. And again, we affectionately stole it. In fact, I started talking last night with our data people because we've got a couple thousand loans now that have gone through the pipeline. We're almost at the spot where we can start analyzing our data and come up with our own formularies. So that said, it is a household size of 4 or more people. Do you have somebody, you got to meet 2 of these criteria. Do you have a household member that's got a disability? Do you have a front-end debt ratio of 28% or higher? I can almost bet you that every single loan that you guys would come across has 28% or higher front-end debt ratio. Are you a sole head of household? Now, I can't say single parent, but that's essentially what it is, right? It's a single parent household that either has somebody under the age of 18, somebody over the age of 62, like you're taking care of an elderly parent, or a household member with a disability. If you meet any of these 2 criteria, boom, you are a focused demographic. Yes, ma'am. Under, sorry. So the question was, yeah, it's 18 and under. So now what are we doing? What's our next, does anybody have any questions about this at all? Oh my goodness, no offense, you're getting last. Okay. Can you explain front-end ratio? Oh, thank you. Okay. In lending, there is what you call a front-end debt ratio and a back-end debt ratio. And seriously, thank you for asking it. What that is your gross income. So we're going to say that you make $100,000 a month for giggles, right? That way it's like, we're not playing the guessing game. If you make $100,000 a month, your debt would have to be over $28,000 of your income. Sorry, your mortgage payment. So your back-end debt ratio is your mortgage payment plus all of your car payments, credit card payments, student loan payments, all of that stuff. Front end is just your house, what we call PITI, principal, interest, taxes, insurance, mortgage insurance. So whole house payment, everything. Great question.
Sure. Scott, thank you so much for this presentation. I've been hearing something and feeling something, and I wonder if it's true, if it's lack of available down payment assistance tied to these programs, or if it's just an absence of education for our network of statewide home ownership centers and developers. So I think, as you know, the Unlocking Homeownership Coalition was not successful in securing what we had hoped for, $40 million in down payment assistance. And I've been talking to homeownership centers who are saying things like, I have 20 people, 20 households in my pipeline that I was hoping to serve by December of this year that I just can't serve now. I'm wondering if that's true or if all of us collectively need to level up our understanding of these programs.
She's asking such a great question. And quite honestly, we have had kind of a drive and a push to change our website, but it's a push-pull amongst, right? Because we want to be clear. Because quite honestly, I wish we didn't have, God, I probably shouldn't even say that, but I'm saying it. I kind of wish we wouldn't have the fact that we have DPA on our website because they think we provide it, right? We don't provide the DPA. Just like you said, that DPA comes from the general fund, the legislature, the taxpayer, and it is given to OHCS to give out via RFA, RFP, which is request for application, request for proposal, what have you. Basically, we set the criteria, and then nonprofit partners, basically, I'm going to call it bid for it, but basically they put an application and talk about how they're going to meet not only our criteria, but what additional things that they're going to do and that they're deserving. And then we distribute out that down payment assistance, and then once it's gone, it's gone. So that's what she's talking about. And that's where I was going to go. So Susan basically said a different section does that. That is completely different than the DPA that we've got. So our DPA is what I'm going to call, because I love fancy words, bifurcated, right? It's split into DPA from the general fund / legislature to go to nonprofits to provide down payment assistance. And quite honestly, it's a super valuable source because you serve borrowers that are in much greater need. The people that quite honestly come through our 4 and 5% DPA, right, instead of $25, $35, $50, $60, $90,000 worth of DPA in one shot, right? These people are typically, I'm going to say, more mortgage ready. However, back to the DPA that you're talking about that comes through the nonprofit partners, that's where we talk about stack it and stack it deep, right? You can use our DPA plus that DPA and put it together. So we have been given a pool of funds by the general fund to pair with, but the legislative directive is to be paired with our lending programs. And the idea, and I'm not trying to be snotty, what I'm trying to be clear, and the idea is so that it actually comes back and creates a pool so we don't have to ask for more funds from the legislature, and the funds that we would ask for would go to do more down payment for the deeper subsidy, as we call it internally, right? You got to have a microphone to talk.
I really appreciate this conversation.
fun.
And I'm on the same page with you, but
Yeah.
here's what I guess I would like to maybe request. I wonder if we could model some of these cases where maybe various organizations have would-be homebuyers in the pipeline, and we knew, right, that if we had, say, 60,000 in CRO DPA and Hope DPA with a conventional lender, that someone was going to get through the door. But could we explore with you or with some of the qualified lenders, like, could we maybe get that same home buyer through the door with one of these products, but we just don't know it? Do you know what I mean there?
Say that one more time.
So what I'm, like, let's just say.
Because I'm beginning to wrap my head around it, but I
Yeah,
just want to make sure I got it clear so I can,
Like
right?
maybe because of the lower interest rate, right? And the forgivable DPA, if someone's 80% EMI or less, right? Maybe they could still qualify for a mortgage, but we just haven't like seen enough of the modeling to understand if that's true or
Okay,
not.
I see where you're going now. And you're totally right. So we launched in November. We basically have been averaging about 125 locks a month, probably 120 to 150 in a month. We're running about an 80-20 split between first home, which is that super low interest rate that we're talking about. Thank you, guys. In fact, if we go to the next slide, I can kind of show you where we're at. So I think that where we're going with this, because it's a great question. Hold on just one second. Because I want you guys to see kind of where OHCS is now. And this is actually a bit low because we've done a lot recently. So we got 34 lenders, right? And our rule is this. So I'll talk about this and then we'll kind of come back, answer questions, things like that. But our rule is that just like we want people to use home ownership centers, is that your lender, your loan officer, and your processor have to be in Oregon or within 50 miles of the border. This is the biggest transaction that they've ever had in their life. And I'll tell you what, the online lenders do not like me. I'm okay with that. I sleep really well at night. Since 2000, the bond program did 19,000 borrowers and $3.1 billion. Flex Lending's done 575 borrowers and 185 million. But here's where we start getting fun, right? Is we did 361 locks in 2024 when we launched that first home product. And I think we're over 1,000, aren't we? Okay, we are over 1,000, right? So a little bit old data, I apologize that, right? So we have done more dollar volume because house prices have gone up, who knew, since like 2009. And we've done, so we've done more home buyers than any time in the last 8 years. We're not gonna break 2018, right? we're going to be really, really close, but we're not going to break 2018. So here's what's cool about this. This is this 813 that I'm so excited about. So we bought 813 loans, and we did that using only $5.2 million. So, which is why you hear me start talking a little bit more about more mortgage ready, right? And the idea is to take a little bit of lift off of the partners that need that deeper subsidy, but I'm with you. We want them coming forward. We want them aware. We want them partnering. And if you're them, thank you, right? So that what we can do is we can have the maximum effects. Next slide.
And that's what this is all about. We need this program that we're doing is, to bring us together so we.
Can you bring the microphone right over to our sweet hand holder there? Oh, yeah. So those are on our website. We've got two sides to our website. Basically, we've got a borrower side and we've got a mortgage lender side, because quite honestly, all of the intricate details of how the structure is and blah, 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 it's not behind a firewall or anything like that. You can find it, right? It's not like we hide it. But the reality is what we really want is we want lenders to, or borrowers to, they want to know, we want them to know who the lenders are. We want them to know who the homeownership centers are. We want them to go there, because this needs some hand holding, right? You really need some. Wells is not on that list. U.S. Bank's not on that list. No. So I'll give you a couple of them, and I probably shouldn't, because I should give you all 34, but let's just, so like, huh? Oh, sorry. People wanted to know what lenders were on that list, and no, Wells Fargo is currently not on the list. U.S. Bank is not on that list. Right now, one of our sponsors, Columbia Bank, formerly Umpqua, is on that list. Let's see here. Banner Bank's on that list. When you talk about banks, who? Guild Mortgage, Director's Mortgage, Loan Depot, Evergreen, Fairway, Go Mortgage. No credit unions yet. We have talked to credit unions. Actually, let's not say that. Credit unions run a really different and interesting model. Some of them utilize a lender that facilitates that for them. Some of them use what's called a QSO model, and that's a whole nother conversation altogether. So somebody asked if there were any credit unions. Sorry, that way I can clarify all of that. We've talked to a few credit unions. Some of them send them through, there's something called a TPO model. If you guys work with lenders that are what you call brokers, they don't actually have the ability to fund that loan in their own name. The correspondent lender that is facilitating that for us right now is Sierra Pacific, and they do a lot of brokered loans. And that we've seen some come from credit unions that way. So they'll send it to Sierra Pacific underwrites it, closes that loan, and sends it to us. So great question. Next slide. Okay. Wow. Do you guys have any more questions before I go on to talk about the right over here and over there? I love it. There's questions everywhere.
Thank you. As a homeownership center, if we want to refer a client over, is the best way to just send them to your website for them to start looking at that list of lenders? Or what would you suggest would be the best way to refer them to this program?
Usually, it is our experience that the homeownership centers already know lenders that they have relationships with. What we will do is we will direct them to the spot on our website where our list of lenders is, to be quite honest with you. One of the things that we're working on that's probably not in here, yeah, it's not. It's a little bit interesting as a government agency, basically taking your top lenders and your top loan officers and putting them on your website without following all of the legal and lovingly bureaucratic, right, process that we've got. But we are starting to highlight who those top loan officers and who those top lenders are. I know that we put that out in our last newsletter, and I know Guild was our number one. I do not remember who my top loan officer was. Do you? Yeah, it changes. So we're trying to do that whole top three thing. So we're headed to where. Yeah, so you guys do have flyers on your table. There are QR codes that'll get you a little bit more information too. So good question. Who has the next one?
I had a question.
Yes.
I have
12.
2 questions. Let's see. Okay, so my first question was, And yeah, so I've had some familiarity with this, but I always struggle a little bit with like kind of the main selling points. So could you just summarize to me, like when I am talking to a client and I'm like, I know about this really good program, you're a first time home buyer, first home, what's your like one paragraph spiel?
So the first question is, who do you work for and what do you do?
Hacienda CDC, and I'm a homeownership counselor.
Here, let me introduce you to this loan officer. is where I would start. But to be
That's
honest with
actually
you,
what I've been doing. So
yeah.
perfect.
I mean, quite honestly, that's because I don't do it every day, right? I can tell you all about all of the dollars and cents associated with it. But to be quite honest with you, Susan, I'm going to hand this off because this is what she loves to do. This is what I don't love to do anymore.
I am so glad you asked that question because my whole reason for being is to tout this program. Part of what I do, besides online trainings that generally happen at least twice a week, I like to go out into the field and visit your office. And anytime you want to have customers or the public come learn about this program, I, like I said, it's what I do. So reach out. We have a link on our website. If you'd like us to come speak or join one of your meetings, we'd be delighted to do that. I can't say enough good things about this. We have gone to a lot of
We've done continuing ed.
yeah, we do continuing education for realtors. We work with our homeownership centers, and
A lot of outreach.
yeah, tons of outreach. So if you haven't heard about us until today, I bet you'll hear about us pretty soon from somebody else because word's getting out. And like Scott says, we are breaking records with the amount of locks that we're doing for deserving homeowners in Oregon. So thank you for all of your support. And just know that we're here for you. If you want to know about it, we will tell you everything we can.
So back to like, I don't have a paragraph, but yeah, it's low rates, but it's really, it's first-time homebuyer lending, right? It is first-time homebuyer lending that's paired with down payment assistance. And, it's, we even get a little bit lower mortgage insurance rate when there's mortgage insurance involved and things like that. So it's just a bunch of little things that stack up to a really big thing. As an HFA, we're afforded a lot of flexibilities that most normal lenders do not get. There are lenders, though, that are slowly getting into the realm of some of the things that we traditionally do, and we welcome it, right? Because there really isn't enough dollars to go around. So it's a good question. Does that?
Yes, and I guess, my follow-up question
Yeah.
is, because I know, a lot of banks, credit unions, they'll have a program that's focused on the first-time home buyer that has maybe some form of, like, what they call down payment assistance. I'm still kind of trying to wrap my head around that. So I guess when I'm communicating to a client, like, here's 5 options. One of your options is first home, and these other 4 options are like this credit union, this bank, da-da-da. How would you articulate, I guess, the specific benefits with going with first home?
So I can't speak to the other, right, to the others, but and I'm not going to try to outsell it other than to say that we don't have overlays, right? With the exception of I've got a 620 on FHA. So it is literally, it is lending as the agencies intended it, which is a little bit different than some of the stuff I've seen, but I have to literally stack up all of the other lenders up against us. And the reality is like I said, some people have some really great programs out there, and I'm proud of them because they're helping to, right, help the Oregonian.
Okay, thank you.
Yeah.
I would just like to follow up real quickly with that. One of the best things that I can share about Flex Lending is whether you are an experienced home buyer or somebody who is brand new to the process, we very likely have something that we can help you with. And Flex Lending has one loan that will always come with down payment assistance and one that it's optional. So that is enough usually to get the conversation started.
Did you have more questions?
I have a suggestion for please consideration.
Yes.
So again, thinking about our current environment and not giving up here. There's no white flag, let's be clear. But without that CRO down payment assistance funding, when I think about the universe of mortgage products with which I'm familiar, there is a especially warm place in my heart for the USDA 502 loan. And the aspect of that loan that really has spoken to me is that if you have a lower AMI, you can qualify for a lower interest rate, which gives you more principal and makes you more competitive on the market.
You're talking about the direct loan.
Yes, I'm talking about that 502 direct. So I guess as I think about that, here's my soapbox. In my lifetime, I would love to see a comparable mortgage product that you could use in a suburban community or an urban community where you're lower EMI, you qualify for a lower interest rate, because that could be enough maybe to like push someone up, without that down payment assistance to be able to make like a competitive offer.
Let's explain to people what a 502 direct loan is. So there are USDA loans. Those USDA loans come in two flavors. They're a direct, and what is the other one called? Team? It's guaranteed? Okay, thank you. So that guaranteed one is underwritten by a normal underwriter, and it's got low interest rates, but it's not got the 502 direct because that goes through USDA. USDA underwrites it. It's only a few $1 million a year that is available to it. I am with you. I'd love to see it. Not sure how we'd administer that, right? The challenge you get when you get into the ultra low rate like that is the amount of administration that is involved. Because like I said, we're trying to help as many people as we possibly can. That's going to require a huge subsidy to accomplish. But that doesn't mean no. That just means that's something that we need to be looking out for and needs to be on our list.
Yeah, so if I may, again, it's a pitch, just a little bit of a pitch.
No.
Like one day, not necessarily tomorrow, but
Bring me your Christmas list.
yeah, not that we can necessarily get down to a 1% effective interest rate, which is magical, and leprechauns are dancing, right? There's that. But like, could we, if we even said like up to 60% EMI, like we're gonna at least take a point off of this, more like something like that could still make a big difference in this market.
Let me show you what's on my current wish
yeah.
list right now, right? So the stuff that is on my current wish list, and I haven't, right? This is not, so the director's already left. So, but actually, so I'm going to tell you a little bit. Did I already talk about how different we are? We're a full government agency. No, I didn't. Okay, so OHCS is a little bit different than the other states that are around us. Idaho and Washington are what you call quasi-governmental agencies, or a public benefit corporation guarantee politic, or I screwed that all up. But it boils down to they're nonprofits whose board is appointed by the governor. OHCS is actually an executive branch agency, department, whatever we want to call it. So we full-on work for government. Most states, what they do is they spin off their HFA, or Housing Finance Agency. That's this team, and the Affordable Rental Housing team, and then they retain their social service option, and that's what Idaho and Washington have done. So we've got it all in one shop. It can be a mess, and we're not a mess, but it could also be a superpower. And so my goal for the future for us is to figure out a way, because we already know that there is a need for affordable rental housing. And what better is to take those people that are ready to move on to home ownership and to pair them with lending so that we can make room for the next people, right? Because literally OHCS starts at permanent supportive housing, works our way into affordable rental housing, and really we're kind of the end of that line, right? And we would like, I dream of nothing more than bringing somebody through that whole system and having somebody realize that dream of homeownership. So that is the first thing that I wish. We got two questions. Hold on.
Okay.
Three.
Oh, sorry.
Go.
I actually wanted to make comments on your comments. We are in the buyer's market right now. I'm not a realtor, I'm a lender. So there are a lot of sellers out there. I'm sorry?
Who do you work for?
I'm working with the U.S. Bank, and we're in the process of trying to get flex lending approved. So, yeah. So
Pressure them.
Anyway, we're in the buyer's market. If you are realtors, when you have conversation with your sellers about lowering the purchase price, consider about providing seller concession to your potential buyers, because many loans out there allow 3 to 6%, depending on which program, of seller concession. So I actually worked with a realtor just last week who the seller wanted to reduce the price by $25,000, but instead we're promoting a lower rate by using temporary buy down, and we got the property sold right away because the seller is willing to put that $25,000 to help the buyers to buy down the interest rate. So that'll get people to get into the house with a lower interest rate.
This is the difference between thinking outside the box and saying what box. All right, you have a question over here? Sorry, didn't mean to skip you. All right, good.
Good afternoon. I'm Laura with Bienestar. I have a question.
Laura.
A lot of this information is always in English. Do you have material in Spanish?
Yes,
And do you have people who can teach it in Spanish?
we do. Forgive me, because I actually tried to take one of my team and have them teach it in Spanish. She goes, yeah, not that kind of Spanish. So, so you're right, I totally forgot. So Magda used to be on our team, and she is in our DEI division, and she does language access. So thank you for asking.
And our agency has a whole language access plan that we've been in the process of developing. It will be public on the website very soon, and it will have pathways for all of our staff. Sorry, I'm Laura. I'm at OHCS also. So we'll have pathways for all of our staff to know to follow for doing like all of our presentations in whatever language. I mean, Spanish is definitely one of our top languages, but there's a whole host of other ones we'll have access to. And we'll also have like interpretation for.
You've
public
got to grab that
meetings.
microphone, because I mean, Laura, you're doing
Oh.
amazing, and it was, yeah.
Sorry, interpreters at public meetings and translation of documents, pretty much any document that you need translated. We can help you with that.
So that's Laura, you said research, right?
Yes, I'm
All right, so it's only because I know that they're putting this on some sort of recording thing, so, yeah, there you go. She's freaking awesome, so.
Not to say that it's a bad thing to have interpreters, but I have found in my experience that teaching a lot of people a class, it is better to have somebody who actually speaks or knows the language well, because having somebody translate it takes away from the information that they're trying to learn.
We agree.
And sometimes they end up with more questions than having learned what they were supposed to have learned. So just a suggestion to hire somebody who actually speaks Spanish.
Well, and if you want to do a class with us, I'm just saying. All right. Hold on, we got one more question over Gigi, right? I know, but we got to get you on the record, right?
Oh, okay. So are you already using OHTCs to give the lower interest rate, or could you, if you utilize OHTCs, could you drop it even lower?
You know you're talking to a capital markets guy, right?
Yeah, I know.
It doesn't math like that yet. I have interest in that. It's the accounting. Oh, wow. I'm going to put you on a conference call with Ty, and then I'm just going to stop. So that said, she's talking about OHTCs, which is Oregon Affordable Housing Tax Credits, and it does not pair with mortgage-backed securities at this time. It doesn't mean that it doesn't mean that that's not something that we're interested in exploring. But right now, the way that financing structure works, not quite yet. I know I'm not supposed to say no. I know that's unpopular, right? But I mean, I would rather give you the quick dirty of the, yeah, I'm interested in it. But figuring out how to flow that through to an MBS and to the end buyers of those mortgage-backed securities or into a bond portfolio, just do it. Oh, I know what you're saying. Trust me, I know what you're saying. I know it sounds really easy, so she's just saying that doesn't quite. Oh my goodness. Okay, so repeat that? Okay. So she asked why we couldn't do OHTCs and use the OHTCs to who we sell the mortgage-backed securities to. A little bit more complicated structure than, we'll talk offline. Next question.
Oh, I just wanted to follow up on Laura's question.
Yeah.
So I know Washington Trust is one of your partners.
Yes, they are.
And we've actually had them come to teach a class to other lenders and to us, and hoping to a class.
Is
pretty
Joseph
soon in
Portillo your
Spanish.
guy?
Portillo.
Yeah. Yep. He's a good man. So, okay, I'm going to keep going with this list of things that we want to do. The other thing that we'd love to see is we'd like to see the state of Utah has something that I'm super interested in pushing. It's a little different than the way that most basically incentives for development are. Is the state of Utah created a $20 or $25 million fund, and what they basically said was, if your borrowers are below 100 or 120% AMI, don't quote me on exactly what it is, you can have up to X amount of $1,000, let's call it $25,000 or $30,000 for down payment assistance. It's got to be new construction, and the maximum sales price is $425,000, $450,000. And so the idea is to bring more new construction online for first-time home buyers to get them out of that marketplace. Manufactured housing and co-op parks, we already talked about that. I'm going to be talking to Fannie Mae next week when I'm there. ADUs, super excited about ADUs, to be quite honest with you. Back to complicated. ADUs are probably going to be more complicated than figuring out how to do 2 to 4 units for generational living. Again, just because of that financing structure, because you probably aren't going to find a house with the ADU already there. But these are the things that we're excited about being able to explore. And it may or may not come to fruition, but here's the deal is you get enough smart people in the room and enough people collaborating, right? And you come up with some amazing solutions. Is there another slide? What's that? Oh, yeah. Hold on. I actually did, so a little bit of a misspeak here. So we don't normally do ADUs. Well, we don't do ADUs on first home, but we'll allow them on next step. But we don't allow any income on it.
Can't rent it out.
Yep. So, yep, generational living. There we go. This is the team. I don't know why we put this at the end. We should have put it at the front, but that's me. That's Christina. Raise your hand. There's Susan. Jill, Angelica, and Julie are actually holding down the fort while we're gone. Bless them. I appreciate that. What's the next slide say? Oh, there we go. You guys, email us. Really, seriously. Email us, hop on the website, whatever. We do a lot of driving people, so don't get offended, right? If you actually need to talk to us, you let us know you need to talk to us. We do a lot of driving back to the lender because we want you guys to have that relationship with the lender. They're actually loaning the money, right? And they're what we call delegated, which means they're the ones that are authorized to make that lending decision. So we do push a lot back towards them, and it's because we don't make credit decisions. They make credit decisions. It's their licenses, their approvals that are on the line for stuff like that. Does anybody have any questions? I hope you guys have liked this, because I enjoy this. I get excited about it. This is, to me, this is like, so you don't need to applaud them. They tolerate me every day. I do this. This is how I am from the time I wake up till the time I go to bed. So, hi.
Do you guys do I-10 loans for families with I-10s?
So we cannot do loans for borrowers that are, so actually, let's rephrase that. I used to answer that yes. And the reality is this, is borrowers have to have legal residency for us to do a loan because all of our loans go through a mortgage-backed security. In order to do a loan for a borrower that does not have legal residency and cannot basically pass muster with the underwriter, then that ends up being a portfolio loan. I can't do it. So it's a good question. It really is. So yeah, technically we do an I-10 loan, but if you actually look at, I wrote like a 9-page memo on this that is like annoying and boring to read, but it all boiled down to, yeah. More questions? No? You guys all done? You have a question? It's cold?
Yeah, but it's actually nice after being hot all day. I was wondering.
I would have repeated it for her, but okay.
I was just wondering about the max prices per home. Obviously, Portland's a very expensive area. So yeah, max prices. And then I was also, well, I mean, more just curious. I started Googling about specific targeted areas in Portland.
Yeah. Okay, so I don't like rules. The only reason that I really like rules is because it gives me the gray areas to shade in. The IRS mandates with the first home loan that there is a maximum purchase price and a maximum income. So it's set by county and whether it's a targeted or a non-targeted area. And yeah, there we go. And then with the Next Step product, we basically have an income cap because to me, I like things, like I said, I don't like rules and I like things simple. 125,000, you can only cram so much into $125,000 worth of income, and that's going to tell you what your max price is depending on what interest rates are doing. So, yeah, so what is it? Is it 700,000 or something crazy like that on Portland Metro? Yeah. Yeah. But it's quite a bit. It really is, because I think our incomes are in the 140s or something like that for Portland Metro. Almost 150, okay. And obviously that depends on whether it's 1 to 2 people, 3 to 4, or 3 or more, et cetera, et cetera. So no, that's a great question. So.
And nobody wants to see that higher.
Yeah, so we're actually working towards, and who knows when we'll see it, we're working towards introducing an increase for Oregon, because we haven't had an increase on the Next Step product since we introduced it, and I think we got approval for it in August of 21 or something like that. Ooh, let's just say this. The other states that are around us, I got 10 minutes, and I'm gonna talk even less than 10 minutes. The other states that are around us are at like 175 and 180, and one of them's going to like 215 for income. So, that being said, we're working on an increase, but we have to go through legal. We have to make sure it's legal. We got to go through our Housing Stability Council, make sure that obviously we have an oversight board. That's our Housing Stability Council, and we partner with them, right? I think our long-term goal, our income limits and our purchase price limits change with first home every year. The IRS sends us a letter that tells us what that is, and then we implement. What we're hoping to do is kind of in lockstep with that is follow along. So if the income limits with our first home go up by 7%, then our income limits going forward after we go to our next adjustment with Next Step will go up the same amount or something like that. We're still working on the formulary that we want to suggest, some sort of inflation adjustment factor so that we don't have to come back every 4 or 5 years or what have you and ask for it. More questions?
I have a question that's more just, given, follow up on your question actually about the folks with I-10. I'm wondering if other people have banks or credit unions that you typically refer clients to, if they do have I-10, programs that that they're eligible for as far as loan products. And then my other question that came up recently was if there's a couple, one person has I-10, one person has a social security number, how does that impact their, what products they qualify for?
It wasn't just road. There's one up here. You know what I'm talking about?
Thank you. So I do first-time homebuyer classes, and I help families with I-10s. So if one has a social and the other one has an I-10, it becomes an I-10 loan. And it's a slightly higher interest rate, and I do work with a couple of banks, United. Well, can I mention them?
Yeah, no, you can, because Point West Credit Union, I was going to name, and Rogue Federal Credit Union are two that I know off the top.
And Rivermark.
And Rivermark.
So then I do, so I work with them, and they do assist with them. Well, they don't assist, but you can apply with them with a 10% down. I have heard before that it could be 20 or 25%, but with them, they do work with 10%. And it's high, but it's a little bit more doable than having to come up with 20%. But I always like to ask because the more information that I get, the better that I can assist my families.
I am glad you asked that question, because quite honestly, it wasn't trying to say, no, too bad, you can't ever have a loan. So thank you for asking, and thank you for giving options, because it literally clicked the brain to.
Yeah, I was going to say the same thing that she's saying, and also the companies that do offer. The other option is to only put the spouse who has I-10 on title only. Then the loan will just be a conforming loan with the Social Security. So that's another option that you can do if they can support the debt-to-income ratio with just the one income.
Wow.
So I'm a real estate agent. I'm licensed in Oregon and Washington, and I had closed a good number of transactions with I-10 holders. Rivermark Credit Union that just merged with Advantist, so they became Rivermark Credit Union. They are pretty good, had pretty good programs for I-10 holders with only 10% down. The interest rates, believe it or not, are not terribly high. We're talking about maybe 0.75 to 1% higher than what the conventional interest rate may be. However, when you become, one of the advantages of becoming a homeowner is the number you get at the end of the year to reduce your interest that you pay on the mortgage. So it's very relative. If you are going to get a higher interest rate, then your deduction is going to be higher. Now, with that said, is the way it is now. We hope it wouldn't change, but if things continue to be the way they are, the higher the interest, the higher is your deduction. So really it's a relative thing. For the state of Washington, I'm also licensed in the state of Washington. Seattle Credit Union is phenomenal. They do have also pretty good interest rate for I-10 holders. And just to add to what you said, if you have applicants, one is a Social Security, one is a I-10, they're gonna give you the interest rate of the highest risk. And how they see it is the I-10 holder who has the highest risk. In addition to that, I also had closed transactions in which my I-10 holders had received assistance from Bienestar in the county of Washington. Washington County is the only county that Bienestar works with. And if you qualify, you can get $30,000 if you are a first-time home buyer. And if you are first-generation home buyer, it can go up to $60,000. Now, with everything that we are going through, we don't know if that will change next year, but as of this year so far, I had closed transactions in which they had received the assistance. I think many times we just don't know the programs are there, but there is a lot of assistance still. We don't know if that is gonna go away next year, what the future unfolds, but as of right now, those are the options, and they are very good.
I actually was just going to wrap it up and just say this, is that we love being your guys' resource. We will help you in any way we can. If we don't have the answer, obviously, we can get it. That being said, if you guys need, you want us to come in and present, you want us to do continuing ed, what have you, whatever it is takes to make you successful, that's what we're in it to do. Thank you, guys.